Hello, students. How are you doing today? Um, well, welcome to the first lecture of FINE453. In this course, where I will be teaching you about investment analysis. My name is Qilin Peng. You can also call me Daniel. And without further ado, let's start with this course. So in today's lecture, the tentative schedule, I will divide the first course into 6 parts. So in the first half hour, I will go through the syllabus with you and covering the lecturer about me, some little bit background about me. Second, the syllabus that I have designed for this course. The third one is the schedule of the course. In total, we have 25 classes. And so far as I know, all the lectures will be conducted through online recording. But for the midterm and the final examination, I would prefer to having it to be an online session, such that every person can attend just under my supervision. And the fourth and the fifth is about some tips regarding the assignments and examinations. In total, we have 3 assignments, and then we have a midterm and a final examinations. So in total, we have 5 homeworks, or like something that requires your efforts. And the final part, I will spend the remaining 1.5 hours regarding the chapter 1. So just bring you a little bit information about the investment environment. Okay, now let's begin with some little bit self-introduction of myself. My name is Qilin, and my surname is Peng. I'm currently a postdoc fellow at the University of Toronto. And prior to that, I graduated from the University of Hong Kong with a doctorate degree in finance. Before PhD, I finished my master's in science degree in operations research from Columbia University with like a 4.0 GPA. And my bachelor's degree is finished in Hong Kong Polytechnic University with a BBA honors in financial services. And my previous teaching experience, including as a teaching assistant for Doctor of Business Administration, Master of Business Administration, as well as Master of Finance courses at the University of Hong Kong. And also, I have been serving as a course assistant at the Columbia University for hybrid and derivative products. So my experience, I'm mostly focusing on the finance parts. Regarding the industrial experience, I also served as head of research at the Hong Kong Y2 Capital. So that's a small like funds, kind of mutual funds company, and I'm responsible for designing the products for them. So if you have any question regarding the future career in, for example, New York City or Toronto or like Hong Kong, or maybe China or Shanghai, I can probably give you some advice regarding the job hunting process in different places. Okay, now let's move to the little bit background information about the investment analysis. So probably this is the second course that you have learned after your introduction in finance. And this course is regarding the investments. Probably you have heard about, like in finance, we majorly divided them into 2 parts. The first part, after introduction of finance, you can have corporate finance track. Corporate finance track. So that is allowing you to serve as the CFO of a company and to determine how you can get the money from the banks or from other alternative sources to finance your projects. And the other one, the other part of finance is investment. So if you are not interested in managing a company, but you are interested in being a capitalist, or even, for example, like a trader, and then probably this course is better suitable for you. So in the investment world, what we need to do is first, we need to understand the investment and environments. So what are the investment environments? Basically, I will introduce you 3 major kind of like investment markets. The first one, stock market. Second one, bond market. The third one, financial derivative markets. And in this market, there are underlying assets that you can invest in. For example, in the stock market, you can invest in different kinds of stocks, right? For example, Apple stock, Alibaba stock, or like Alphabet stock, like Google. And also in the bond market, you probably can invest, for example, like US Treasury bond, US Treasury notes, like that is issued by the United States government. And second, you can invest in corporate bonds like HP or like all the other like Disney. They issue bonds, and then you can buy their bonds, and by investing in these kind of like fixed income products. The very last market, and also the very dynamic market, is called the financial derivative markets. Probably you have heard about the futures market often. And in the futures market, you can purchase oil futures, gold futures, like all other currency futures, or many other places, maybe agriculture products like beans, rice, or like meat and milk, orange juice, these kind of futures. And then all these products that is exchanged in the futures markets, it belongs to the financial derivative market. But futures market is not the sole market that is included in the financial derivative markets. So now let's look at the derivative market. We have forward markets. Usually foreign exchange rates are exchanged under the forward market. And also you have futures market. So as what I have mentioned, cottons, gold, precious metals, or like oil, energy, electricity, all this kind of stuff, they can be exchanged in the futures market. And also you have options markets. Probably you have heard about the book, Options, Futures, and Other Derivatives. This is written by a University of Toronto professor called John Hu. He is the main person who has contributed to the development of the derivative market in the academia, or like in finance research. And the others, we have many other different kinds of like derivatives than ETC. Probably you have some derivatives regarding the weather. You have derivatives regarding the antiques or real estate market, REIT, for example. REIT is basically real estate investment trusts, where you can invest in the real estate market. For example, invest in a property management company that owns many kind of like apartments, and then the company it just rented out the apartment to collect the rent, and then redistribute the rent to the REIT investors. So this is also one type of derivative. So many kind of like trusts are belonging to the derivative markets. We will see it later in the second half part of this lecture, of this project, of this course. Okay, and this topic will include, after we understand a little bit about the investment environments and different kinds of financial markets, and we will see about the trading rules of the securities. So securities is an aggregate term that stands for all the underlying assets that you can trade in the financial markets. For example, like stock, like bond, and the derivatives I have just mentioned. These are all belonging to securities. These are the notes or the papers or contracts that is of value. And then it stands for some kind of like represents some future income with these notes, with this paper, followed by a more in-depth analysis of the key investment topics. So in this investment world, we need to develop some theories, and also we have some observations in the market. So some topics that we can think about are first, asset allocation. What is asset allocation? Think about you as a portfolio manager, and then you are endowed with, for example, $10 billion. And then you need to manage this $10 billion and make money out of that, right? So asset allocation simply means how you will divide this $10 billion to invest in different capital markets. For example, if I want to invest 30% of my assets into the stock market, 20% into the bond markets, and 50% into the derivative markets. That is one type of asset allocation. Or you can change. You can have 50% to stock and 30% to bond and 20% to derivatives. This is another type of asset allocation. Okay, after you allocate the assets, then what is the next step? Okay, since now you have decided to invest 50% into the stock market, right? Then the next step is to find in the stock market which stock would outperform the others. So probably you will need to allocate among, for example, US stock markets, China stock market, Hong Kong stock markets, and also like Japanese stock market. And from different markets, you need to pick up some stocks that you think it will beat the market. For example, in the United States, probably you will buy Apple stock. In China, probably you will buy some, for example, China Mobile stock. And in Japan, you probably buy some Toyota stock. This is how you do the portfolio management or security selection. So this is the process of managing a fund. So start with asset allocation, and then we move to portfolio management. So this is a top-down approach from the very top towards the very bottom. Top stands for like what kind of markets you will be invested in or assets you will be invested in, asset class. Bottom means individual stock, individual security, not necessarily need to be stock. You can invest in bond. You can invest in some kind of like gold futures, but you need to specify which contract you are interested in, right? And then after your investments, the next thing that we need to consider is to measure how your investment goes. For example, in the beginning of the year, you allocated your assets, and now it's the middle of the year. So what you need to do, you need to calculate your performance. So this is regarding the performance measurements. So we have two different types of performance measurements. One is absolute. So absolute performance measurement simply tells me how much money have you earned throughout this half year. For example, I can say I have earned 20% comparing to myself at the beginning of the month, at the beginning of the year, right? And second, we have a relative term. Because currently it's summer 2022, and then previously we have a big event, big issue of like Russia invading Ukraine. So in this term, the global stock market has depreciated a lot. Like Standard & Poor, that stands for the United States stock market, has depreciated, for example, 20%, negative 20%. But if during this period of time, my portfolio makes 20% surplus, and then the global markets drops 20%. So the relative term, I have made 40% like alpha, that's excess return, right? So in terms of the performance bonus, in terms of the salaries, how should my salaries as a portfolio manager be determined? It should be based on my performance, right? If you can make more than the capital market, then I should be rewarded more of the bonus. But however, let's imagine about another situation. If the overall stock market increased, like for example, like 30% plus 30%, however, I have only made 20% out of my portfolio. So that means my relative performance is negative 10%, right? So means I'm inferior to the capital market. The customers, instead of like investing in my own funds, they would rather invest in the capital markets, like an index fund. So in this sense, I should get no bonus because of my inferior performance. So this is how we do the performance measurements and to evaluate the portfolio manager's performance. And next, we will talk about capital asset pricing model. And in short term, that is CAPM, capital asset pricing model. So CAPM, you can think about it as a core of this course or regarding in undergraduate level investment course, CAPM is the core of all the financial investment courses in the undergraduate level. What does CAPM tells you? CAPM simply tells you the investments returns and the risks are associated. And then we build a very simple linear regression model. And then we say that the expected return of any asset should be equal to the risk-free rate plus a beta. The beta stands for a coefficient for the systematic risk measure, and times market return minus risk-free return. And this very little kind of a linear regression model is exactly the CAPM. So the graphic view of CAPM is simply a line, right? A linear line. And then this linear line, you can kind of like pricing all kinds of assets, so long as you know what is the risk-free rate. So in reality, how do we find the risk-free rate? We simply take, for example, United States Treasury notes or Treasury bonds, 5 years or 10 years as the risk-free rate. Currently, I think it is about 2%. And then we need to find another one, that is the market return. So how do we find the market return? We simply take Standard & Poor's 500 index return in the United States. So if in the last year, S&P 500 gives you 17% return, then the market return is 17%. And then this risk-free rate is still like the 2% as you have here. So the only thing that you need to calculate the expected return of any asset is the risk measure beta. So once you have the risk measure, then you already know what is the expected return that you can get from an investment vehicle. After CAPM, we will be talking about arbitrage pricing theory. Think about it like that. Arbitrage pricing theory is nothing more than we just extend the CAPM. This is simply one factor model, right? If you look at the formulas, we have only one factor. We call this as market risk premium, RM minus RF as market risk premium. And now arbitrage pricing theory says like, no, you cannot simply take into consideration just one factor. You probably need to take into consideration 2 factors, 3 factors, 4 factors, 5 factors. So in academia research, we simply add more and more factors at the back. So if you have more factors, then it becomes arbitrage pricing theory. This is just an augmentation of the CAPM, capital asset pricing theory model. So previously we have been focusing about the stock market, right? Even though we say CAPM, you can price in anything, but usually CAPM is used in the stock market pricing. Okay, after the arbitrage pricing theory, before these are the stock markets. After that, we will be focusing about the bond markets. So term structure of the interest rate simply tells you, okay, for 1 month, how much interest rate, how much interest can you get? For 2 months, how much interest can you get? For 1 year, how much interest can you get? And then after you find different month or different time and different interest rates, and then you can draw a plot. And then because when you go to a bank, if you deposit your money for 1 month, you probably get 0.001%. But if you deposit for 1 year, probably you get 0.1%. If you deposit your money for example, 10 years, probably you can get 2% of the return of the stock, like the interest rates, right? So this is what we mentioned about the term structure of the interest rates. It's simply a diagram representation of the investments of the interest rates. And also we will be talking about market efficiency. This is a standalone topic. We'll talk about bonds and derivatives and behavior finance. This is almost all of the lecture. So simply divided into stocks, bonds, and derivatives. And plus, we have a behavioral finance, we have some market efficiency theories. These are the standalone topics. In this course, I will have some quizzes for you, but the quiz is only for your kind of exercise purpose. It's not graded, not graded. And we will not have weekly assignments because we have a very intensive lecture. We will be finishing this course within 1 month. So in total, we have 3 assignments. So about every week or every 2 weeks, we will have an assignment. And we have a midterm and a final examinations. So during the course, we will probably using some Excel to help us solve some difficult questions. But in your midterm examination or final examination, there is no need to use the Excel. But you may be allowed to use the financial calculator if you find it difficult to get the results. The course is used for introduction to the Chartered Financial Analyst curriculum. So if you want to work in the financial industry, especially in the investment field, then probably you have heard about the CFA credential. And then after you learning the FINE453, I think you may probably be well prepared for CFA level 1 curriculum. But remember, CFA level 1, in total, they have 10 books. They do not necessarily only test you about investment. They also test you about statistics, economics, and accountancy, as well as some bond markets, stock markets, derivative markets, and many others. So after you learning the investment analysis course, you may probably have already covered 3 books of the CFA level 1. But I mean, the statistics, probability, and economics, you probably have already learned in some other courses. So I think as a finance undergraduate, after you may probably be able to attend the CFA level 1 curriculum at your year 4. And then if you want to really work in the investment bank or really work in the for kind of portfolio management company or fund, then CFA designation is necessary for you to succeed in this career. Okay, regarding my course, I will divide them into 4 parts. The first part is exactly today's lecture, and together with tomorrow's and the day after tomorrow's lecture, the first 3 lectures, I will be covering lecture 1, 2, 3. So in lecture 1, we will be getting some understanding about the investment environment. Second, in the next lecture, we will talk about the financial markets, basically stock, bond, and derivatives, and the other securities, what you can invest in different kinds of financial markets. The third lecture, we will talk about the security trading rules. So because if you want to trade your securities, usually you will trade it under a stock exchange or probably other futures exchange. And in the exchange, there is some trading rules. You may not be able to exchange whatever you want. For all the securities exchanged under the exchange, traded in the exchange, then probably you will have a standardized contract. So you may not have so much flexibility. But you can also, instead of stock exchange, EX, instead of exchange traded securities, you may also have OTC securities. What does OTC stand for? It stands for over the counter. Over the counter. Think about the counter as an office of an investment bank. Then you come to the office of an investment bank and you say, okay, I want to buy something. And can your bank sell this thing to me? And then the investment banker says, okay, no problem. We can have a contract with you. And then this contract is simply between us. And you may not be able to resell the contract to the third party. Then this is the OTC market, over-the-counter market. It's simply tailor-made, specified contracts. In the second part, we will be covering investment analysis. Majorly, we will be focusing on stock analysis. So to analyze the investments or to stand in the shoes of a fund manager, what you need to do, you need to first begin with a macroeconomic analysis and the industry analysis to understand what is going on in the world and what kind of industry would be beneficial if you want to invest in. For example, during the pandemic time, COVID, and then probably you need to, it's better for you to invest in pharmaceutical industries, right? Like Pfizer, like Moderna, and this kind of like a pharmaceutical company will give you excess returns if you invest in their stocks. Second, after you determine you want to invest in pharmaceutical industry, then you need to pick specific stocks. And the specific stocks to be able to pick, you need to analyze the financial statements. For example, to look at which industries give you higher return on equity, return on assets, and kind of like high liquidity ratio, this kind of stuff. We will also have technical analysis. Technical analysis allows you to study the patterns behind the stock movement. For example, if you have been seeing a stock movement like that, you will probably assume in the future, the stock will still go up, right? Because there is a momentum, there is an inertial in the stock movement. But if you see something like that, like this, you say a very kind of like a smooth trend. From a very beginning, you have a very fast increase. And after that, the kind of like the returns become stable. And you probably assume the next step will be decreasing. So this is the technical analysis. By simply looking at the patterns of the stock movement, stock price movement, then you are inferring, you are using the past information to infer the future. So this is more like a forecasting. And the third one is behavior finance. Behavior finance simply is a combination between finance and psychology. So in psychology, we have so many biases. So people are not really rational, and then they do some mistakes. They make some mistakes, right? They become kind of like irrational. Then in the stock market, people also do that. So we can make profit out leveraging people's mistakes. Okay, the third part of the course is about asset pricing. So to price an asset, the major part we have been talking about is the capital asset pricing model, as well as the arbitrage pricing theory, right? So we will be majorly covering these two models, and then at the end of the lecture, you will be able to price very simple kind of like stock and also very simple bonds. Whether these models can be used in your real life, that's not certain, because in real life you have many other kind of like factors that may violate your assumptions. But it's very kind of like it's good to begin with a simple model, and then after you graduate, you enter into an investment bank, and the investment banking will augment what you learned in the lecture CAPM. Probably investment bank where instead of like using one factor model, they use 1,000 factor models. But still, the logic behind is the same. So after learning CAPM and arbitrage pricing theory, I think you will be fine to learn more by yourself. And the fourth part is about the portfolio management, or how you can achieve diversification. We have always heard about the saying, like, do not put all your eggs in one basket, but put your eggs in different baskets, right? So in any case, if one basket has fallen to the ground, then only the eggs in that basket will be broken. The remaining eggs will still be saved, kept alive. But if you put all the eggs in one basket, if the basket like keep falling, and then all the eggs get broken. So this is exactly the ideology that we will bring to financial investments. To invest in the industry, to invest in the financial capital markets, probably the best idea is to invest in different asset classes and to invest in different stocks, different bonds, right? However, as a retail investor, For example, if you only have 1,000 US dollar or 1,000 RMB, so probably you will not even be able to afford a Google stock, even 1 unit of Google stock or 1 unit of Amazon stock. So what can you do with small money, with a kind of like a small amount of money? You can invest in mutual funds. So you can buy 1 share, if you have 1,000 RMB, probably you can buy 1,000 share of the mutual fund. And after the mutual fund gets your money, mutual fund can invest Google, can invest Amazon stocks for you. Then in this case, with 1,000 RMB, you can still invest in kind of like hundreds of thousands of asset classes. So this is called diversification. The second part is the second type is called hedge fund. Mutual fund is simply some guy manages your money, right? And they are doing exactly the same thing as the retail investors. But hedge funds, these guys, they are different. So who will be the hedge fund guys, hedge fund managers? They are usually PhDs, doctors of physics, mathematics, rocket science, or like many other like nuclear science. Or those mathematical guys, or those quantitative guys, or computer science PhDs. So they will use mathematical models or artificial intelligence models to find arbitrage opportunities in the financial capital markets. For example, they will leverage the behavior finance mistakes. They will use the technical analysis and to find statistical arbitrage opportunities. And in this sense, hedge funds, they are making risk-free gains. So they are more like statisticians in a casino. So they make certain gains by trading a lot. Hedge funds, if you look at their kind of like their performance, they are usually like this. So your fund is quite stable, and then you keep moving upward. And the mutual fund is like investing in stocks. You have very highly volatile kind of style. But no matter you invest in mutual fund or hedge funds, this is some kind of method that you can diversify as a retail investors. And also we have international funds for international diversification. Previously, many funds can only invest in domestic stocks or domestic bonds, right? But nowadays, with the globalization, as a Chinese citizen, you can also invest in Canadian stocks, US stocks, Japanese stocks through investing in different kinds of like foreign direct investment funds. So this is how we achieve international diversification. And we have many companies, for example, Morgan Stanley, Capital Investment, MSCI, and also Fidelity, BlackRock, and Blackstone. All these kind of companies, asset management companies, they will offer you some kind of like funds that you can invest for to get exposures to the global capital markets. Okay, now regarding what we will be learning in this course, the main textbook that we will be referring to is the investment textbook. This book is commonly used in Australian universities. So probably if you go to, for example, University of Toronto, you go to McMaster University, or you go to UBC, you will also use investment, this book. And we are now referring, in my course, I'm referring to the 9th edition of the book. This is the newest edition, and it's just published in 2019. And usually after every 3 to 4 years, the books will update for different version. If you happen to have 8th edition, 7th edition, it's okay, because the only change they have is very trivial. And then they probably just change the arrangement of different chapters, and then the main content will not even change. The examination materials will only cover the materials that I have delivered through the lecture PPT, but it's always good if you can read the investment books. And 3, use the end of chapter questions for practice. As I have mentioned, I will give you some quizzes, and then you can use these quizzes, not graded quizzes, for exercise as a practice questions for your midterm and final examination. And finally, if you have any question, because this is a recorded course, and you may feel free to ask the teaching assistant or forward the question to me through email, and then I will respond at my earliest convenience. Okay, regarding the schedule of this course, we will in total have 25 courses. In the first lecture, I will talk about lecture 1, chapter 1, and chapter 2. But because we covered the syllabus today, so I probably only have time for chapter 1. Then chapter 2 will be kept to the next lecture. Okay, and we will have assignment 1 due after the first week, and then we have the second assignment at the end of the second week. Because we start this first lecture today is Tuesday, so I will give you like 7 more days to finish the assignment 1. But keep in mind, before each assignment due date, we will also have the tutorial day. We will have the tutorial study day. And the tutorial study day, the teaching assistants will help you answer any questions you probably have. So if you find the assignment quite difficult and you do not know how to tackle that, I strongly recommend you to attend the live session of the tutorial day. And I will demand the teaching assistant do not directly give you the answers, but she may be able to give you some hints about how to tackle the problems. Okay, and in the day 16 and day 17, day 16, we will have a midterm review session. This is an online session. So I will be sitting here and answer any potential questions that you may probably have. At day 17, I plan to have this lecture at July when? Wait. I plan to have it in July 15, okay? That's a Saturday. So probably, if you have time, so if this schedule suits everybody's schedule, then I will confirm this examination time. Otherwise, we can still reschedule because it's early in this course. And for the final examination, I plan to have it on July 30. And this is also a Saturday. So if you need to reschedule your final examination, also let me know, because we have we don't have much students for this course. So we can make a coordinate adjustments to suit your schedule. And we also have the final review session just 1 or 2 days before the actual examination. So it's also an online session, and then I will be sitting here answer any potential questions that you may have. So right before assignment 3 is due, we also have a tutorial day, and the tutorial day teaching assistant will give you some hints about how to solve the questions. About the grading criteria, we will have 3 assignments. Each assignment carries 5% of the mark. Even though 5% of the mark is not is not so much, but this is a very good exercise for you to prepare for midterm and final examination. And since we have a recording lecture, so I will not be able to take attendance for you. So the participation rates, I will be simply grading based on whether you have submit your assignments on time. If, for example, you have a delayed submission past the assignment 1 deadline, and then you submit your assignments, okay, I will still grade your assignments based on how you perform, whether you get the correct answer for these 15 marks, but you will lose marks for participation because you have been late submitted and without excuse, without prior appeal of the leave. Okay, and in total we have 100% of the grades. And then we will have a tentative schedule, and you may figure out this table. If you score 90 or above, I will give you A, and that stands for GPA 4.0. And if you have 85 to 89, I will give you A minus, that is around 3.7 GPA. And If you have like 82 to 84, you get a B plus. B plus is about like 3.3. And your 78 to 81, you have B. B is equivalent to 3.0. And then if you have a 75 to 77, you will have B minus. B minus is 2.7. And I wish I do not necessarily need to give the kind of like the C plus or below, because there's no meaning like if you are attending this lecture and give a very low grade. I wish to give everybody like B minus if you finish all the assignments and all the midterm and the finals. But if you want to score high, there is no curve. So if everybody gets 90 above, I will give everybody like A. If everybody gets like 85 above, I will give like A minus. There is no curve. So don't worry, just be yourself. But plagiarism or like copying others' answers is strictly prohibited. If I find any sign of kind of like academic dishonesty, then I will give you like fail. Regarding the assignments, assignments will be distributed right before the tutorial day tutorials. So we will have like 3 to so assignments. I can probably, for example, assignment 3, I will post it at day 18, and assignment 1, I will post it probably at the 3rd lecture, because the first 2 lectures doesn't have much to be examined. And assignment 2, I will post it at the day 9. So you will have like around 1 week to finish your assignments. You can discuss with your friends, but just do not submit the same answer to me. And right before the deadline is set at the end of 11:59 p.m. at Beijing time. So submit it right before the deadline to my email, and then write your name, write your topic of the, for example, assignment 1, assignment 2, assignment 3 of FINE453. Then I can give you grades. And for midterm examination, the tentative schedule is July 15, and I will give you 1.5 hour. That's on in-class Zoom lecture, and I will please open your camera so I can see you, and I need to ensure that you do not take unfair advantage over other students. So it consists of multiple choice questions, numerical questions, as well as short essays, short answer questions. And for the final examination, there is a 2-hour online examination, and it will be held now, tentatively, it's July 30th. And during our Zoom lecture, also open your camera so I can see you. Okay, now let's move to the chapter 1 of this lecture of the course. Chapter 1, we'll be talking about the investment environments. Okay, and to note the copyright of the slides, this is the PPT provided by the book at the end of the chapter, and the slides are prepared by Cactus from the Concordia University, and specifically for the book Investment, 9th edition. Okay, now let's look at what we will be learning in this chapter. First, we will get some sense about the real asset and financial assets. So these are the very core ideas. Real assets are simply the assets that will give you future cash flows. For example, like cars, like a house, or like whatever things that may generate some future income, or maybe somehow like a production line. So those are the tangible assets, and you can really see it. These are the real assets. What is financial assets? Financial assets are simply claims on the real assets. For example, a company, you can think about a company as a real asset because company generates future income, right? And then for the company, you will have bonds and you will also have stocks. Because in in accounting, you have the accounting equation: assets equal to liability plus equity, right? Liability stands for bond, Equity stocks stands for stock. So this bond and the stock, these are the claims on the assets. Assets are something that you can see it and you can sell it, you can touch it, but financial assets, you cannot touch it. It's simply a paper, it's a contract. The contract simply tells the ownership or the kind of like a liability between two parties. So financial assets will also give you future cash flows, but it's more likely intangible assets. And the second part of the chapter, we will talk about the risk and return trade-off and the efficient pricing. As we all know, the market or the world is fair. If you have higher risk, you get more return. High risk, high return. Low risk, low return, right? So we want to establish you this concept. Like if you bear more risk, you will have higher return. If you have higher return, you probably bear more risk. So this is the risk and return trade-off. And efficient pricing is simply, we want to use some formula to represent the risk and return trade-off. And that is the CAPM model that we will be talking about. Because currently it's simply the chapter 1, so we want to look into detail about the CAPM pricing model, but I will simply give you some ideas, some concepts about the efficient pricing. The third part of the first chapter is more about the storytelling, that I will be telling you something about the financial crisis in 2008. And we will learn some lessons from the financial crisis in the most recent financial crisis. And then probably in the future, if we face more financial crisis, then our textbook will change. But because it's the book is written in 2019 and the COVID spread, COVID-19 is not spreading pandemic yet. So we will be focusing about the most recent financial crisis in 2008. Now, let's look at the real assets and financial assets. Real assets, by definition, they have productive capacity. Like what I said, a car, a house, they can, for example, a car, you can transport customers, right? Or even if it's your own car, you are not using it for a commercial purpose, but still, it can generate some productive capacity. If you're driving a car, you can commute from one place to another. So this is a productive capacity. And also you will have a building, you will have land, you will have machines, like intellectual properties. You can, basically for the economy, you can use these factors for production. These are factors for production. In Chinese, we call it 生产资料. Okay, and in financial assets, these are by definition the claims on real assets. So this is simply claiming, okay, I have these real assets. I own this car. I own this land, or I borrowed some money. I borrowed this machine, right? So these are the financial assets. And the financial assets do not directly contribute to the production. As we know, you cannot use money to generate or like to produce toys or to produce some other foods, right? You cannot, maybe you can, in some extreme event, you can burn money to make cook food, but that is very rare. But in reality, what we do, we use the contract simply to stand for your ownership or stands for your liability. But this contract will not directly engage in the production cycle. So for example, the financial assets include stocks and the bonds. These are the contracts. These does not have a physical kind of a shape. Financial assets, as we have mentioned, they are claims on real assets. We divide them into 3 parts. The first part is called fixed income securities. Fixed income securities, probably this sentence is kind of like a fresh to you, and probably you have never heard of it before. But if I change it to another name, you probably know it better. We usually say fixed income securities. The most common fixed income securities is a bond. In Chinese, we say fixed income securities as 固定收益产品. Okay, so why we say it's fixed income? It's because there are something like a bond. They give you the coupons or they give you cash flows at a periodical time. It does not necessarily need to be a bond. It can be something similar to a bond. For example, REIT, Real Estate Investment Trust, or mortgage-backed security, asset-backed security, or some other like bank sold products that generates fixed income for you at a periodic time. So all these kind of products, we make them into a classification called a fixed income security. The second part is the equity side. Equity side is simply stocks plus common shareholder stocks plus preferred stocks. So this belongs to the equity part of the financial assets. And the third part is the derivative. Derivative usually generates their value through the underlying assets, right? So a very typical derivative is the what's that? Typical derivative, you can say insurance, or something like a CDO, right? But a credit default swap, CDS, credit default swap. Credit default swap is simply like an insurance that is insuring a bond. If a bond defaults, so if a bond does not pay you back the money, the principal and the interest, then what you can do, you can use the CDS as the insurance to claim some remedies from the CDS seller. Usually the CDS seller is an insurance company or an investment bank. And insurance is a very typical type of derivative because insurance guarantees. If you buy an insurance, you go to insurance company tells you, okay, if you get critical illness or if you died, unfortunately, then I will pay your parents, or I will pay your family, your offsprings, some money. So the underlying asset is basically your life or your critical organ, right? Because critical illness is usually divided by heart, head, or some other arms, legs, those kind of stuff. And then your organs or your life is the underlying assets. And whether your insurance policy is in the money, which means the insurance company will give you back the money, or it doesn't give you anything, that's depending on your life condition and your critical illness condition, whether you are sick, right? So this is the underlying assets. So basically you realize the financial markets is simply these three markets. We have bond markets, we have stock markets, we have derivative markets. So these three markets simply covers all the financial assets that are possibly can be traded in the markets, in the financial industry. Besides the very three common financial markets, we have some other markets that is also used, but not so frequently cited. The first one is the currency market. So we say it's a forex market, foreign exchange markets. Remember, foreign exchange markets is about 12 times the size of the stock market of all around the globe. So foreign exchange market is the most dynamic market in the world. But why we do not often hear about foreign exchange market, but we hear the stock market movement more, is because for individual investors, it's very hard for you to participate in a foreign exchange market. Forex market is primarily dominated by interbank market. So what does interbank mean? Interbank means a bank is having the transaction with another bank. So if you are Bank of China and you are Citibank, then you can engage in a transaction for the foreign currencies. For example, RMB exchange for US dollar. But for individual participants, if you want to participate in the foreign exchange market, probably you need to find Citibank, and you will go to Bank of China and say, okay, I want to have RMB, and you go to Bank of China, say, okay, I want to have a US dollar, but you cannot directly find another person to simply directly exchange the money. I mean, I understand some people may exchange the currencies in the WeChat group, but this is how to say, illegal. I mean, foreign transactions by individuals is basically illegal. So that's the reason why the legal foreign exchange market is primarily dominated by the interbank market. It's because only the large banks, large financial institutions are allowed to participate in the transactions. And individual customers, they can exchange currencies indirectly through a bank. Okay. And also we have a commodity futures. Commodity futures, you can think about it as one small part of the derivative market, or you can make it standalone. The reason why we make it standalone is because the commodity futures is kind of frequently traded. Usually we will hear about the oil price, we'll hear about the gold price, silver price, and also we have like the agricultural product, meat, and wheat, etc. Right? Because we hear these kind of like commodities so much, so we make it a separate kind of market to trade these assets. And financial market and the economy, the information. So how can financial markets contribute to the development of the economy? Because previously we say financial assets, not like the real assets, they are not the ingredients of productions, right? So financial markets, they can contribute to the development of economy indirectly through first, information channel, information role. What does that mean? That means if you are an investor and then you want to invest in a company, but if the company is not listed, so which means the company does not issue any stock or does not issue any bonds, then it's very hard for you to get understanding about how the firm performs, because there is no legal requirement demanding that all the companies to disclose their financial statements. But if a firm is listed, which means the firm has goes through IPO, the firm has already issued stock, or the firm has already issued bonds, then you will get more information by looking at the financial statements, balance sheet, income statement, and statement of cash flow, CF statement. You know, listed companies are required to disclose their financial statement, and also through the auditing company. So this will give the market more information about the performance of the company, instead of like a black hole, right? The second one is consumption timing. What does that mean? Okay, imagine a world there is no financial market, which means there is no bank, and there is no stock, no bonds. You only have your real assets, like a caveman, right? Like 5,000 years ago, like people live in a cave, and then people do barter. People exchange their something, for example, their meat for clothes. So this is the caveman, this is the ancient and ancestors, what our ancestors do. So because the meat cannot be stored for long, right? If you store the meat for very long, the meat will decay and you cannot eat it. But clothes, you can put it for longer enough. But however, if you put the clothes longer, then the clothes will probably broken some holes, and there are some like bugs and damaging your clothes. So in the ancient world, if there is no financial market, if this person, he caught a pig and then he have the meat, you have to consume the meat or sell the meat immediately to another person to have the meat consumed immediately. And the person who make clothes, they need to sell the clothes immediately. Maybe so afterwards they realize they can store their value, store their wealth through gold, right? Through a commonly accepted storable stuff, that is gold. And after that, with the gold and the financial market gradually develops. And nowadays, instead of like storing gold, you will have a bank account, and you will always have some savings in your bank account. The reasons why you want to have savings is because for today, you want to save today's purchasing power, because money simply represents purchasing power, right? You can, for example, you make 10,000 Canadian dollar per month, and then if you only consume 8,000 per month, you will have 2,000 more to be stored. These 2,000, if I exchange it into, for example, tickets, right? Maybe airplane tickets. For example, between Toronto and Beijing, the air ticket is like 2,000 per for round trip. Okay, and then what you this means for every month, your capacity, your salary will worth 2 tickets, 5 tickets, and then you will consume 4 tickets. You will have 1 ticket to keep, to save, and then after that, in the second month you will have another ticket saved, and in another month you will have another ticket saved. So at the end of the year, you will have like 12 tickets saved. So this is the purchasing power you have been storing in your bank. So by doing that with the financial markets, this is a simple saving example. So you can save for future consumption, right? You do not immediately buy those 5 tickets. You only need 1 ticket, but you can store your tickets, your purchasing power in the bank by opening a savings account. But in another regards, if you want to buy a car and you do not have sufficient money, if you want to buy, for example, Porsche that needs you 100,000 Canadian dollar. Okay, but now you only have 20,000 Canadian dollar. So what you can do a financing for the Porsche car, right? You borrow like 80,000, and this borrowing is simply using futures money. So with the financial market, we will be able to either postpone our consumption or kind of like move forward, take advancement of our consumption. And the third function of the financial market is the allocation of risk. What does that mean? It usually involves in the use of the derivative. Think about a company that is selling toothbrush, a Chinese company that is selling toothbrush to Canadian, for example, Dollarama. Okay, and because the toothbrush is shipped to Canada after, for example, half a year, and then Dollarama will only pay the Chinese manufacturers in Canadian dollar after half a year. And then the Chinese manufacturer is quite worried about like the depreciation of Canadian dollars. Then what can the Chinese manufacturer do? He can probably approach Bank of China and ask if I can sign a forward contract to exchange Canadian dollar to RMB after half a year. So by signing this forward contract, the toothbrush maker in China is simply hedged off this currency risk. And this currency risk is simply bailed by Bank of China after this contract. So with the financial markets, and we can kind of like transfer the risks through the shape of a contract. And then this contract can be moved, like can be resold to different type of person. And finally, you will give the right person the right amount of risk, and give the another person who is risk averse, give them a low amount of risk. High risk, high return. So for those aggregate, for those aggressive investors, or those who are adventurous investors, they are willing to take high risk. So they are willing to sell these forward contracts. And for someone who is more conservative and someone who does not like risk, then they can buy a forward contract to fix the rate, and then low risk, low return. This is high risk, high return. Okay, these are the first three parts of the financial markets role. And also, let's look at the second role of the financial markets. That is the separation of ownership and the management. Without financial markets, then you only have the asset side, right? So it's usually just you starting your own company and you are the sole owner of your company. So you are both an owner and you are a manager. However, whether you can always be a good owner and a good manager, that is in doubt, right? You may probably have a lot of money, but you simply do not know how to run a company. Or you may simply know how to run a company, but you do not have enough money. So in either case, without the help of financial markets, then there's no company established. Only when a person who is good at managing a company and who also have money will start a company without financial markets. Then that will greatly kind of like reduce the economic activity of our society, right? But nowadays, we allow owner and the manager to be separated. And then after we establish a company, then we can sell the stocks to investors. And then we can maintain these managers, CEOs, CFOs, we can hire them like by paying salaries, right? By doing that, we will be able to find the best talent of the CEO instead of like you have to find somebody in your family who may not be able to well manage your company. So this is called professional kind of like management. And we have a chief executive kind of like markets of the talents. So this is how the large companies, especially listed companies, they try to manage their corporations. Maybe this example is quite abstract. Let me give you a more concrete example. For example, the Rockefeller family. You probably heard about the Rockefeller Tower in New York City, right? And this tower is established 100 years ago by Rockefeller family. Rockefeller made their first fortune by selling the oils. They found the oil fields in the United States, and then they become the very large giants, super wealthy family in the United States. However, nowadays, if you check the website of the Rockefeller Group, then the CEO is not named after Rockefeller. It's named someone else. Then why is it like that? It's because the Rockefeller family simply becomes owners, and then they hire professional CEOs to help them manage their family business. However, whenever you have a separation of ownership and management, there will always be agency problems. Why is that? It's because the CEO and the owners, because they are not the same person. And for different person, you have different interests, right? Maybe the owner's interest and the management's interest is not aligned. So the managers might, for example, get corrupted, and then they spend the company's money and for personal profits. This gives rise to agency problems. The third use of financial markets is the mechanism to mitigate agency problems. Okay, because we have the financial markets. So first, you will have external monitoring from the board of directors. This is internal monitoring, sorry. Board of directors, in Chinese we call 董事会, right? So the board of directors will supervise CEOs and renew their contract on a yearly basis. So if the CEO is performing bad, then for the next year, he will lose the job. He or she will lose the job. Second, time managers' income to success of the firm. So usually the CEO's salary or CEO's compensation is not purely based on fixed income salary. It's also have a performance bonus. And the performance bonus is usually associated with the stock price of the firm or the market value of the firm. If under the CEO's management, the firm's assets or the firm's stock price appreciated 20%, then the managers will get rewarded for that. But if under a CEO's management, the firm's stock drops to 10%, so negative 90% drop, and then this probably the CEO or CFO probably did a very, very terribly bad job. So the CEO CFO will need to be changed. And also with the financial markets, we will have the investment banks, and we will also have the big four accounting firms, right? Like KPMG, EY, PwC, and Deloitte. Okay, so with all these professional advisors and accountancy auditing firm services, so what they can do is they can give they can monitor the performance of the company. And then, for example, auditors, if they find if there is any kind of like mistake in the financial statements, they can issue kind of like an opposite opinion regarding the financial statements. So this represents an external monitoring channel for the company's management. And finally, the takeover threats is because if a CEO or CFO is doing bad and then make a decrease in the firm value then the firm might probably be acquired by another firm. And usually whenever a large firm A acquires B, then the B CEO or CFO will be fired. So instead of like making really bad to the company, then the CEO or CFO may probably face the threat of losing their jobs. So this is also a kind of like a mitigation channel to the agency purpose. And finally, the financial markets can help the economy by improving or strengthening the corporate governance and the corporate ethics. Let's look at historical events. That's Enron, or like in Chinese we call it 安然公司. Okay, the accounting scandal of the Enron. This is the previously it was the largest like natural gas company or energy company in the United States. And however, in 2003, the accounting firm discovered that Enron has made a huge mistake in their financial reporting, and they just went bankrupt. After Enron's bankruptcy, then U.S. government have taken it so serious, and then they passed a law called Sarbanes-Oxley Act. And this Sarbanes-Oxley Act, you can think about it as the boost of the auditing industry. Prior to Enron, auditing is simply a trivial or very small industry, or like very small amount of like professional is required for auditors. However, after 2003, after the Sarbanes-Oxley Act, then almost all the listed company needs to hire an external third-party auditor to monitor or like auditing their financial reports to prevent some kind of like accounting scandal from happening again. So what does Enron do? Simply because in their balance sheet, they have assets, liability, and equity. However, Enron, they say like they have a lot of assets like gas fields and many other land buildings, things like that. However, this asset does not never exist. So because this asset never exists, however, the liability cannot be diminished. So therefore, whenever the asset is smaller than the liability, then the debt holder might file for bankruptcy for the company. And then the largest energy company of the United States just went to bankruptcy in 2003. And this is a huge event. So with the supervision from the financial markets, it is less likely for the company to conduct such misbehavior. Okay, now let's look at the investment process. As we have already mentioned, as a portfolio manager, what you need to do, you need to start from asset allocation, which is to choose how much money you want to invest in stock, for example, 50% in stock, and 20% in bond, and 30% in derivative. This is asset allocation. And after your asset allocation, next step is to find the security selection. So in stock, in bond, and in derivative, you probably need to find, for example, you want to invest in Amazon. And in bond, you probably want to invest in HP. And for derivative, you probably want to buy some oil futures. So this is exactly security selection. Simply means you want to find individual stock, individual security under each asset class. Okay, and for the investment process, what we have mentioned, we mentioned about the 2 steps, right? One is asset allocation. The second one is security selection. However, in the world, even though almost 80% to 90% of the investors, they use the top-down approach, which is they start with asset allocation. First, they decide which asset class they want to invest, and then they pick the stocks. However, there are a minority, about 20% to 10% of the investors, they use the bottom-up approach. So what is bottom-up approach mean? Bottom-up simply means you start with finding individual stocks. You find individual securities. So you do security analysis first. And then you do asset allocation. And top down is from asset allocation to security analysis. So these are the 2 different types of style of managing your portfolios. And usually the bottom-up approach is not, it's not macroeconomic driven. It's usually motivated or driven by some specific events, event driven. So whenever you find, okay, there is a huge potential gain for a certain stock. For example, when Donald Trump sanctioned Chinese kind of like stocks, and then the Chinese stocks plumped, for example, 30% per day. And in the other day, it will jump up like 10%. So usually people simply buy those stocks that is sanctioned by Donald Trump, and then wait for the rebound, right? So this is one typical example of the bottom-up approach. Then let's look at the risk and return trade-off. As we have keep saying that risk and return are highly positively correlated. So high risk means high return, and low risk means low return. Second is the efficient market. The definition of an efficient market, or we say it's in Chinese 有效市场, is because we think the prices, if a price of a stock can quickly adjust to all the relevant information, then we say the market is efficient. So efficient means 有效, right? Because the reason why the prices will change is due to the coming of new information. If there is no information coming in, then the stock price should not move. But if there is good news coming in, the stock price should jump upward. If bad news comes in, the stock price should jump downward. And this is how we define efficient market. However, in reality, you do not simply see this clear jump, right? What you will see is this gradual increase, and whenever the bad things happens, and even though the bad things doesn't even make into public, you have some like dropping before the news become public. That is because there will always be someone who get the information before the market, before the others. So this is called the insiders. Insiders will be able to help the prices adjust quickly. This is also insiders. Because when good news happens, but before the company make public announcement or the media disclose such things, and the CEO, CFO, or their relatives might probably be hearing this news right before the public announcement. So we see the price movement happening before the announcement. And last part is a passive management. So passive management and active management. What does passive management mean? Simply means if you are a portfolio manager, you are not trying to beat the market. You simply want to copy what market do. So how is market doing? For example, in the United States, the market portfolio is called S&P 500. S is standard, P stands for poor. Standard Poor 500 index, or maybe some other index. We also have Dow Jones Industry Average. We also have Russell 1000 stocks, this index. So instead of like beating these markets, the portfolio manager will simply construct a portfolio that's mimicking the behavior of the indexes. For example, if you want to mimic S&P 500, you simply buy exactly the same stock as the S&P 500 index and maintain it. So this is a passive management. Usually when you buy a mutual fund and the mutual fund says blah, blah market, for example, US market stock fund, or maybe like a China SME 50 market fund, these are the passive index fund. And then the passive index fund, because the fund manager are not doing their extra work, they simply copy what others do, right? So there is no legitimate reason for them to charge you a super high management fee. So usually you will see passive management charge you super low management fee. But the alternative, the opposite side, is called active management. Active management are usually hedge fund managers or some aggressive managers. They try to pick up a good investment and such that they can beat the market. They try to find the mispriced securities to make excess gains, excess returns. And it's very critical about the timing of the market. So they want to buy low and sell high. So this is the active management. Usually if you buy some like active management fund, then they will charge you 2%, 20%. What does that mean? 2% is the management fee. For example, if you deposit 100 million, then for every year, you need to spend 2 million to the fund manager for rewarding their actual work. And 20% is if the fund manager happens to help you make fortune. So 100 million becomes 150 million, then the fund manager will be able to receive a bonus. The bonus is 50 million, exactly 150 minus 100. That is the 50 million that is made by the portfolio manager, and then times 20%. So the fund manager will be able to receive 10 million bonus. Comparing to the base salary of 2 million and the 10 million bonus, did you see why we say the fund management industry is super kind of like wealthy and rich? That is because the base salary is already quite high, but their bonus can be 3 times, 5 times, 4 times, 10 times higher than their base salary. Okay, the players of the financial markets, we can divide them into many parts. First, we have firms. So firms are usually the borrowers because firm needs money to expand their production. And then we have households. Household, you can think them as individuals or like families where they deposit money to the bank, right? They have money. And the third one is government. Government can both borrow money or government can make investments. So government can be the savers. And if we draw it like that, we have firm, we have household, and we have a government. And in between, we need financial institutions to help connecting the household and the firms. And also the government can have connections with the household and firm. So financial intermediaries or financial institutions, what are they? These are all the financial institutions in the world. including investment companies, usually found, and banks. This bank will specifically represents commercial banks, so which is responsible for getting the deposits from the customers and make loans. And the third one is insurance companies. Insurance companies, they are taking the insurance policy, they are giving out insurance policies and taking the insurance premiums. And for example, like Berkshire Hathaway, right, of the not Bill Gates, of Buffett, like his insurance company is one of the most profitable insurance company in the world. And also we have a credit unions. Credit unions are smaller regional banks. You can, but it's not like a full licensed bank. It's simply a credit union. It can only make loans and take small deposits. Okay. Universal bank activities. And regarding the banks, we can divide banking into two different types. One is investment banking. The other is commercial banking. Investment banking are other banks that helps companies to issue bonds or issue stocks. So it's underwrites new security issues. Underwriting simply means the investment banks are responsible for issuing new securities for the firm. So they sell newly issued securities to the public in the primary market. Usually when you go to interview, and then the bank or the fund portfolio management company will ask you if you want to work for the primary market or for the secondary markets. Primary market simply means you are doing business for IPO or for bond issuance. But secondary market is the market for trading the already listed stocks and bonds. So that's the second-hand market. That's investment market. Commercial banking is the opposite. Commercial banking, as I have mentioned, they take deposits and they make loans. So this is a very traditional banking. But investment banking is more likely developed in the most recent 200 years. Oh, no, not necessarily 200 years, but the very earliest investment bank should be the one, the whole Netherlands Stock Exchange, right? 400 years ago. Netherlands Stock Exchange issued like a Netherlands Shell company or Netherlands like East India company as the first stock in the world. Okay, and finally, we quickly look at the financial crisis of 2008 before I let you go. So in 2008, we have the Great Moderation, and this is because of the bust of the US housing bubble, right? So we have been keep hearing about the housing bubble in the United States, but not necessarily everybody know what happened in 2008. As we know here, we see in 1980s, the stock market of the United States, this is a S&P 500 index, and what I have already mentioned, S&P 500 simply represents the market index, the US stock market. We figure out throughout the year, the US stock market has been keep increasing unless there are two exceptions. One is the 2000 dot-com bubble. And the other is 2008 housing bubble. Other than these two exceptions, all the other periods are facing great kind of like a high appreciation of the stock market, right? So the reason why we have this sharp increase in the US stock valuation is because United States, the Federal Reserve keeps a low interest rate. So they have been kind of like offering excess money supply to the economy. So it pushes up the stock market. And during the financial crisis, we see in 2006, we have reached the peak. And then in 2011, we kind of like reached the bottom. And during this period of time, we see the upside is 180, the lower side is 120. So almost 1/3 of the value is gone in the capital market. And after the crisis, or like during the crisis, what we see is because, as you can see here, in between January 01 to 07, we have a very low interest rate of the LIBOR, right? What is LIBOR and what is TBO? LIBOR stands for London Interbank Borrowing Rate, and TBO stands for US Treasury Bill. So these are the risk-free rates that we have been referring to, risk-free rate. LIBOR is a floating rate. It changes every day. And the TBO rate is a fixed rate. It's usually like determined every quarter by the Federal Reserve meetings. So as we can see here, in between 07 to 01, and the interest rate is below 1%. It's super, super low. So everybody purchased home by borrowing money. And after that, in 2007, the Federal Reserve suddenly increased the interest rate. And in 2009, they even further increased their treasury rate, right? So in this sense, the spread is becoming larger and larger. But for the TBOs, you also see like here, Federal Reserve is increasing their kind of like interest rate. And because of this financial crisis, Federal Reserve have to decrease the interest rates to lower this interest rate. And after 2008, the interest rate have been kept at a historically low level. So that leads to the uprising of the Canadian housing market as well as the US housing market after 2008. Okay, after the 2008 financial crisis, the housing finance has changed a lot. Before the housing bubble, like in ancient time in the 1990s, the old way is usually you need to approach a bank, and then the bank will supervise, will check whether you have enough income, you have enough assets to support your bank loans, right? So in this time, in this old way, once the bank make a loan to the borrower, to the homeowner, then the loan will be live outside for 20 or 30 years, 25 years, right? And then the loan can be gradually collected back by monthly mortgage payments. But in a bank's perspective, this way is super, super, super slow, right? And after 25 years, probably the bank can only make like 2%, 3% per year. Even though banks can still make money, but bank cannot make large amount of money. So this is a traditional way of making loans. However, in the financial crisis, we have many financial innovations. We have many new products in the financial world, which allows the bank to quickly adjust their balance sheet. For example, now the bank still makes a loan to a homeowner. But after they making the loans, the homeowner will be responsible for returning the mortgage payments, right? This is still the traditional one. But the bank, now it figures out, instead of like holding the loans for 25 years, why didn't I just sell the loans to another special purpose vehicle or another investment firm? And then the investment firm will simply directly give back all the loans, the principal amount of the loans. And then the mortgage payments will be passed through to the special purpose vehicle. And after that, special purpose vehicle can issue some mortgage-backed securities to investors. Investors give back the money to special purpose vehicle. In this sense, so this loan has become off the balance sheet of the bank, right? So no longer at the bank's balance sheet, but at the balance sheet of the special purpose vehicle. And special purpose vehicle allows investors to invest in mortgages, to invest in the homeowner's repayment of the mortgages. And the investors usually they do not have a good investment opportunity, right? So once the bank says, okay, you can have a mortgage-backed security and it's risk-free, and you can make maybe, for example, 5% per year or 10% per year, the investors will be super happy, and then they will buy mortgage-backed securities instead of like saving in the bank. So by doing that, it allows the bank to generate as much loans as possible. So this is exactly the reason of, this is exactly the typical example of the agency problem. Because previously bank needs to hold the loan. So bank need to take extra care to make sure that the homeowner meets the standard of making loans, right? So bank is super cautious. But if we allow the bank to sell the loans to another person, and then the banks only makes the mortgage fees, for example, the charges of the homeowner when the homeowner is applying for the mortgage, then the bank will take very recklessly. The bank will never take it serious. And if you look at the movie called The Big Short, you find out like in the United States, people can even make loans or maybe even apply for mortgages using the name of a dog. So that's crazy, right? So that is the reason why in 2008 there is a financial crisis. It's because there are so many subprime homeowners. The so-called subprime homeowner are usually the guys who doesn't have a job, who cannot repay the mortgages. They simply buy the house because the housing price is appreciating. If a housing price is depreciating, then they will no longer be able to repay the mortgages. So instead of like repaying the mortgages, the homeowner will just default and give back the house to the bank. And in this sense, the investors will no longer receive the money from the mortgage payments, and then the investors simply their principal, their money is simply gone. Okay, and the bank end up with a lot of like houses on hand. So all these things happens because we have the whole process of banking making loans and sell the loans to a special purpose vehicle, and special purpose vehicle issue mortgage-backed securities. This process is called securitization, or in Chinese we call 资产证券化. Okay, in conclusion of non-conforming subprime loans. Subprime loans, as I have mentioned, the banks, because they do not hold the loans by themselves, so they do not care where the loans are making to, so they can make loans to those not qualified borrowers, and then those not qualified borrowers are named as subprime. And there is no documentation loans, rising loan to value ratio, adjusted rate mortgages. These are the confounding effects. So if a bad thing happens, there are many other bad things also happens. Because you are making subprime loans, you do not make a well documentation, and you do not know what's the credit history of the borrower, and then that is making the financial crisis happening. Okay, this is the diagram from the book, where the book try to explain how kind of like these things happens. So first, at the beginning, we have a homeowner who wants to buy a home, and then they will go to approach a bank. The bank is the originator, and then the homeowner can borrow, for example, $10,000 US, and then every month they will repay the mortgage payments. P&I stands for principal and interest. So this is the mortgage repayment. Okay, after that, the originator, basically the bank, will sell their mortgage to an agency. That's what we call special purpose vehicle or investment firms. So instead of like so once the bank sell the mortgage to special purpose vehicle, the special purpose vehicle will give the money back to the bank, right? But when the bank deliver the principal and interest payment to the agency, to the special purpose vehicle, the bank will also charge a service fee. So this is why banks are willing to kind of like make these loans. And then when the agency have this principal minus service fee, then the agency, the special purpose vehicle, will also charge the guarantee fee for, and after that, the remaining fee will goes to the investors. So the actual money input is from the investors to the homeowners. And finally, the mortgage repayment goes to investors by subtracting the originator's fee and agency fee. So this is the securitization process. Okay, and during 2008 financial crisis, the financial product that is to be blamed the most is the collateralized debt obligation. So this is a mortgage derivative. So what does collateralized debt obligation mean? Means we have many mortgages. So first, bank have mortgages, right? And if the agency purchase many mortgages, mortgage 1, mortgage 2, mortgage 3, mortgage 100, and then we make them into a pool. So this is called collateralization, collateralize. And then collateralize means there are some underlying security, there are some underlying assets that's collateralized for the security. That's called 担保. Okay, 有担保的债券. Okay, and then because mortgage is securitized by a mortgage is collateralized by the house, right? So it's collateralized debt. And then after you have the pool, you can make it into be the asset side of the special purpose vehicle, and then you will have the debt side and the liability side of the special purpose vehicle, equity side of and the debt side of the special purpose vehicle. You can divide the special purpose vehicle debt into different tranches. You can have junior tranche, you can have senior tranche. What does this tranche mean? It means even though you have the debts of the special purpose vehicle, I have the debt of the special purpose vehicle, but the priority is different. If you have a senior debt, so whenever the special purpose vehicle goes bankrupt, senior debt holder get the money first, and then the remaining part goes to the junior tranches. Why people were willing to buy the junior tranches is because junior tranches give you probably 15% per year, and the senior tranche give you only 3% per year. So high risk, high return, right? By doing that, people will be able to locate their corresponding appropriate risk level. And rating significantly underestimate risk. What does that mean? That's that is saying the Moody's and S&P. These are the credit rating agencies, and then the P and the Moody's, they are doing a bad job. The reason why the rating agencies they are doing the bad job is because S&P and the Moody ratings, they are paid by the special purpose vehicle. If you are paid by someone who have conflict of interest with you, then probably you will do the special purpose vehicle a favor, right? Even though the senior tranche is not that senior, but I will still give it AAA, AAA rating. And the junior tranche, even though in actual it might be BBB rating, but I will give it AA rating. So this is the reason why we say like credit rating agencies is also liable for the financial crisis. But for the investors, from the investors' perspective, you do not necessarily know what's going on here. You will only see the bank's promotion booklet, and it says senior tranche is AAA, AAA, and that is of the same risk as the bank's saving, and it gives you higher returns, 3% in comparing to 1%, then probably the guest or the investor was simply willing to buy the senior tranches instead of like saving in the bank, right? Okay, why was credit risk underestimated? It's usually because first, they are using the historical records to make forecast of the future default probability, and that's usually misestimated. Second, usually a bank's mortgage is not geographically diversified. What does that mean? That means once, for example, in New York metropolitan area, and the bank is operating there, and all these mortgages are coming from the New York metropolitan area. And in Los Angeles metropolitan area, all the mortgages are coming from the Los Angeles metropolitan area. So whenever there is a risk, for example, in New York, probably there is a typhoon or there is some snowstorm, and then probably the default rate happens altogether, right? There are somehow hidden correlation among different mortgages. They are not independent. And also we have a agency problem with rating agencies, as what I have mentioned. Because rating agencies are paid by the special purpose vehicle, they will do their customers a favor by rating them higher. And we also have a credit default swap. Credit default swap, as I have mentioned, you can think about it as insurance against default. Okay, now think about that you are a person, you are an investor. Now you purchase a bond. You give the money to the bond, and you are promised to receive the payments from the bond. However, you are quite worried the company that issues the bond might go bankrupt in the future during the bond period time. So what you want to do is you go to an investment bank, for example, JP Morgan Chase. And then you say, I want to buy insurance. If the bonds default, then can you, JP Morgan Chase, repay me the remedy? So, okay, if default, cover the cost. If there's no default, then the individual person will pay an insurance premium, right? So we are not, because we do not mention this credit default swap as insurance, so we call it CDS premium. But that is exactly the money that it needs to buy the insurance. Okay, so whenever there is a default happen, so when the bond default happens, and then the bond probably only 40% can be recovered, and 60% of the value is gone, then JP Morgan Chase is responsible for repaying the remaining 6% to the person. That is the meaning of the CDS, credit default swap. Okay, risk of systematic risk. So what is the rise of systematic risk? What is systematic risk? This is a risk that is associated or bailed by all the stocks or the securities in that specific markets. So if one defaults, for example, in the United States, if one bank like Lehman Brothers, right? If Lehman Brothers goes bankruptcy, and then Lehman Brothers will usually brought down other big banks. So Merrill Lynch got purchased by Bank of America, and JP Morgan was purchased by Chase Bank. So that's the reason how these two banks survived the financial crisis. But Lehman Brothers bankruptcy is imposing a huge amount of systematic risk to the United States financial system. And the waves of selling, as we know, if one person is default in the mortgage, and there are more and more people will get default in the mortgage, right? So it becomes that banks end up with many houses on hand. So banks want to quickly liquidate the house and get the money back. So in this sense, the banks will will auction the houses, and the houses will be sold at a super cheap rate. And the potential contagion. Contagion means it's spreading. So instead of like this housing bubble happening in the United States in Wall Street, however, it's spreading all over the world. And in China, we have also been impacted by lowering our exports in 2008. And the rise of systematic risk, the second part continued. Banks mismatch the maturity or liquidity of their assets and liabilities. That is because in banks, we know bank take deposits, right? So bank's liability side is deposit and equity, and the bank's assets are the loans. By definition, we know why banks charge you spread. It's because deposit is usually short term, but bank loans are usually long term. So there is a maturity mismatch. You are using a short-term financing to financing long-term assets. So whenever you have any difficulty with the deposit, with the short-term financing, then your bank might probably be facing a bank run. So bank will go bankrupt. And the banks is highly leveraged because the equity side is usually less than 1/10 of all the asset of the bank. So bank has the highest leverage than any other manufacturing companies. So this might be kind of counterintuitive. We all believe like banks are safe, right? But actually, reality, banks are not safe. Banks are highly leveraged, which means whenever the economy is turning down, then banks will be greatly negatively impacted. And investors rely too much on credit enhancements through structured products. The credit enhancement is usually done by the credit rating agencies, and the people only rely on AAA ratings, BBB ratings, all these kind of ratings, and people does not really look into details why they get these ratings. And CDS traded mostly over the counter. Because of the over the counter, as I have mentioned, you simply go to the office and sign a contract with the bank. So if something is not supervised in a stock exchange, then the government will not know how large this CDS is. So if there are so many insurance policies, and whenever there is a huge catastrophic event happen, then the insurance company can go bankruptcy, right? So that's the reason why AIG in 2008, the largest US insurance company, also get bankrupted because of issuing too much CDS. And opaque linkage between instruments and institutions. So we do not know which institution is actually offering us because of the sophisticated structure, like you are transferring the loans, transferring the mortgages to one another, and you are issuing tranche A, tranche B, tranche C. So it's very hard to know which institution is responsible for what kind of stuff. And the shoe drops, that's how the big thing happened, right? In 2007, we have the mortgage-backed security surge, and that is because there are many housing defaults, so which causes the collapse of the CDS and the CDO market. In 2008, Bear Stearns, Fannie Mac, and Merrill Lynch, Lehman Brothers, AIG, they all went bankruptcy. So because of many recognizable global firms, these are global firms, they get bankruptcy. So they have very negative impact to the financial market, because financial market is purely based on confidence, built on confidence, right? And all of a sudden, you tell me banks go bankrupt, insurance company go bankrupt, and the government agencies go bankrupt. And this is so extremely scary. And the people are super reluctant in depositing their money into a bank. And also, even if you deposit your money into a bank, you are very reluctant in making investment in stock market or bond market. So in this sense, the money market breaks down. Then many firms cannot raise money through the money market. Credit market frees up, and many creditors, they are reluctant in making long-term loans, and the federal bailout stabilized financial system. If there is no federal bailouts, which means the US government is printing money to save a lot of like big banks and big financial institutions. If the United States government does not save the banks, and then there might be a catastrophic consequence for the U.S. Financial system. The Dodd-Frank Reform Act is the U.S. Federal Reserve, U.S. government response to the 2008 financial crisis. And after the Dodd-Frank Reform Act, then because it realized for most of the time, the problem lies in the bank, because the bank does not pay much attention to their balance sheet, to their risks, so banks get bankrupt. So after that, after 2008, this Dodd-Frank Act is passed in 2010 and signed by Barack Obama. And after Obama, these so all the banks are responsible for reporting the risk levels. So that's the reason why after 2008, there are many Chinese students studying in the United States end up as a financial risk analyst that is created by this Dodd-Frank Reform Act. So just now we see two main kind of like laws. The first one is Sarbanes-Oxley Act after Enron's bankruptcy. And then we have like the auditing industry surging. And after the Dodd-Frank Reform Act, we have the financial analyst, risk managers surging. But probably after COVID, we have another job opportunity in the financial industry. Who knows, right? And the very last part is the Canadian experience of the financial crisis. Luckily, in the US housing bubble does not contingent the Canadian housing market quite a lot, even though at that time, Canadian housing market dropped a little bit. However, because Canadian banks, they are kind of like more safe than US banks, and they are more conservative in making mortgages, which means they check the credit history of the homeowners, the mortgage applicants more seriously, and then they do not do these kind of like fancy CDOs and special purpose vehicle stuff. Part of the reason is because of the weak financial system of the Canadian market, and they are not as sophisticated as the United States. So the problem with the United States, the kind of like the special purpose vehicle securitization, because in Canada, it simply does not have this market, have this securitization market. So Canadian market is less impacted by the financial crisis. Okay, that's the end of the first lecture, and I wish to see you in the second lecture tomorrow. Okay, good luck. If you have any question, please feel free to ask me or ask the teaching assistant at your convenience. Okay, bye-bye.